Welcome back to Algo Trading series using PineScript and TradingView from Market Secrets. In this episode, we are going to talk about the critical items that you need to take care while creating algos. That's a topic for discussion today, and it's more likely going to be a theory. Before we get started with the today's session, Market Secrets is proud to announce the launch of Algo Traders program ATP, where we will train people to create and deploy algo trading bots with end-to-end setup. If you are someone who wants to take up algo trading, then it'll be a perfect place for you to start. I'll leave the link to the details of the ATP program in the description section of this video. And with that note, let's jump into today's session. Over the last few months, through this algo trading series, I have demonstrated that simple strategies make money in the market and we don't have to write much complicated strategies to make money. And with algo trading, we get rid of any emotions that we have attached with any particular trade, and also it removes all the biases as well. So that's why the algos, when deployed in the real time, can actually be able to replicate the backtested results if market acts the similar way. But there are few things that you need to remember while taking up algo trading. Number one, having a critical and clear mindset. You cannot just jump between strategies when it comes to algo trading as well. You need to give it enough time. I mean, you have to give the strategy enough time for it to produce the desired results. You can't just deploy a strategy today and expect it to make money on a daily basis. Sometimes there will be drawdowns, sometimes there will be drawdowns that you won't expect as well. I mean, sometimes there will be breach in the drawdowns when you compare it with the actual drawdowns that you got during the back testing. But before you deploy any strategy, have a clear understanding. Don't deploy it for a day or two. Deploy it with a long-term view in mind. So whenever you deploy any new algos, you should clearly give it a time frame. For example, 6 months, 1 year, 2 year, and you need to evaluate it only after that particular period, or if something goes terribly wrong. Just for the normal drawdowns or normal losses, you're not supposed to, change the algos, because if you keep on changing, it may not work. That's item number one. So have a clear and critical mindset. Number two, backtest it using real life simulations and conditions. Don't backtest it with some irrelevant data and irrelevant symbols on irrelevant time frames. Backtest it with the real life simulations. For example, right, if you want to deploy it only on Nifty, backtest it only on Nifty. And if you are going to trade on 5 minute chart, backtest it only with a 5 minute chart. Likewise, right, your backtesting should be based on the real life simulations and conditions, not based on some random metrics. Some people will backtest with every data, every time frame, and all of that. If you're not going to deploy it in that particular setup, there is no point in backtesting in that particular period or for that particular condition. So have that clearly in your mind. And if you find the potential to optimize the code, then you can definitely try to optimize it. For example, right, maybe some minor adjustments when it comes to stop losses, or minor adjustment when it comes to entry. Those fine tuning and optimization, you can definitely consider doing it if you spot any really good opportunities. But again, you need to test that before deploying it. So optimization at any point is allowed, but altering is not allowed. That is what you need to remember. And when it comes to back testing, right, you need to always include the transaction cost. So when it comes to transaction cost, if you're doing algo, right, there might be a charge for API bridge, there might be charge for the data, there might be brokerage charges, there might be API charges, there might be regular exchange fee, there might be STT, and I think there is a insurance cost for tail traders protector fund or something like that, right? So there are a lot of cost involved in transaction. In addition, right, slippage cost will be there. For example, right, you might want to enter a trade at 150, but the moment you enter, right, it might go to 160, 170, 155, 158. So the slippages might be there. So those are all needs to be factored in. And most importantly, right, if you are using 1 lakh rupees capital, right, for 1 year, if you haven't used it for trading, put it in your bank account, you would have got 7% interest. So thus 7% interest is the opportunity cost. Those all needs to be factored in as part of your test. So those needs to be eliminated when you take up the final profits. So a lot of people miss this and blindly go with the results. and results might give you 10 percentage, but if you take out all this cost, right, it might end up at zero or even negative. So always include all the costs that you can think of when it comes to algorithm. Same goes for eb cost, or your internet cost, or your machine cost, and also the machine usage cost. So there are a lot of factors like that, right? So all of those needs to be factored in before you come up with the target percentage for that particular algo. And always include a risk management and positional sizing in your results. So it's an algo after all, so something might go wrong. Yeah, the code might break, API might break, some issue with your broker, some issue with the terminal, some issue with something. Okay, so all of those needs to be factored in while you go for algo trading. And same with positional sizing, you cannot blindly change positions every other day. Okay, it should be fixed position sizing with proper scale up plan. That is how you need to have your algos prepared. Otherwise, right, all of this work that you're putting in, it might go waste. So those are the things that you need to be aware of before you jump into algo trading. And finally, even after making sure of all the points that I have given, right, you need to stay careful, and you need to monitor the strategy periodically, because market dynamics may shift anytime and make any strategy unprofitable, or it might break any strategy, and it may take things in the unwanted or unpredicted directions. So always keep an eye, and try to monitor the strategy, and have things in place. If something goes wrong, right, you should automatically get an alert. You should have a setup like that to ensure that nothing breaks. So with that, we have come to end of today's episode. If you have any queries, comments, feedback about this episode, leave it down in the comment section. I'll be happy to address it. Also hit the like button if you like this video, and share it with your friends if you find it useful. Also subscribe to our YouTube channel and click the bell icon to get notified whenever we upload a new video or conduct a live session. Thanks for watching. Have a great day. Goodbye.